Welcome to Nova Scotia Nightmare, how to avoid another QuadrigaCX. My name's Nick. I'm a CoinDesk reporter who's been covering QuadrigaCX since before its collapse in January. I'm joined here by Oren Blonstein of HBUS, Rob Peon of AirSwap, and Itai Malinger of Curve.co. Yeah, let's get started. I guess just to maybe quickly summarize the QuadrigaCX story for those of you who haven't been following. It's a Canadian crypto exchange. At one point, it was Canada's largest crypto exchange. In January, it reported that its CEO had passed away while on a charity trip in India and taken the private keys to some $200 million worth of crypto, to the grave with him. So we're going to talk a little bit, I think, about how to maybe avoid a situation like this from happening again, how to, prevent nefarious users from stealing cryptocurrencies, and just how exchanges can maybe help out. So Oren, I think I'd like to start with you. You're a decentralized exchange representative here. What's something that cryptocurrency traders and investors maybe should know? What should they look for when looking at exchanges to try and figure out what they want to trade or store?
Sure. Yeah, I think something important here is that some people specifically choose risky exchanges to trade on because there can be more opportunity there. I think when I talked with some people who traded on Quadriga, the reason they were trading there was because there was a huge arbitrage opportunity. So some people, I think, really understood the risk, and I think that's more at the institutional level. At the individual, consumer level, I think that's where it's important for them to really evaluate how established is that exchange. Have they been in business for a number of years? Do they have stated policies on what they would do in the event of a breach? And then I think a really critical thing is, do they operate within a regulatory framework, like an MTL or MSB or broker-dealer or ATS? If they have those kinds of things, you're probably going to find more regulation or more processes, better technology in place. If you find a startup exchange and there's like one guy at the top, that's probably a warning sign.
Right. So Quadriga was, as I understand it, at the end, it was run by one guy off his laptop, and when he reportedly died, no one had access to the laptop. I'm going to assume that's not the case at HBUS. Can you talk a little bit about what kind of procedures or policies you guys have to, that your customers can know about to prevent this kind of situation?
Sure. Yeah, I think in general, most exchanges will talk about different layers of security that they have. So that some of it will come on the technology front, some of it will come through process. And I think one of the key things you can take away from the Quadriga incident is that people can say that they have a lot of things, but really where you can be more confident that those things are in practice are through the use of third-party auditors, regulators, people who come in and actually verify that those things are there. So that's something that certainly HBUS prioritizes quite a bit. We're also able to leverage the technology from our strategic partner, Huobi Global. They have hundreds of millions of dollars in assets under their custody. They've never had a major security breach, and I think that kind of speaks to their commitment to security.
Right. Rob, so traders aren't just limited to using centralized exchanges. Can you talk a little bit about how, what alternatives they have and what safeguards, these alternatives might provide for customers?
Yeah, I think that right now, when you look at a lot of the issues, it has been because of a variety of problems with centralized exchanges. And there was a lot of hype early on in regards to decentralized exchanges. It was something that I think mid to late 2017, early 2018, I think we're starting to see now that conversation around whether it's decentralized exchanges or even the case of just non-custodial trade, where there might be some element of centralization within the exchange or within the process, but essentially being able to trade directly from your own wallet. So the phrase like not your keys, not your coins, that is, I think, becoming more and more important. And whether it is a variety of decentralized trading venues on places like Ethereum or on platforms like Ethereum, or you have other companies out there. I think KuCoin has worked with Arwin, which provides non-custodial trading through KuCoin, or you have Binance now trying to move to Binance Dex, which I think is even more so prevalent now that Binance was hacked for $40 million or so. So I think that type of narrative continues to develop, especially as some of the more trusted cryptocurrency exchanges like Binance are still susceptible to security breaches.
Right. So I want to come back to the idea of not your keys, not your coins in a minute, but really quickly first, can you say a little bit, are there trade-offs to using a decentralized platform like that? Is there a safeguard that a centralized exchange may be able to provide that a decentralized exchange cannot?
Sure, so I think some of the biggest trade-offs right now to decentralized trading is liquidity. A lot of the venues are either sourcing their liquidity from centralized exchanges, or the liquidity is not there to the point of larger trades. I would say the biggest risk as well for decentralized trade, a lot of it is reliant on smart contracts, and smart contracts are not they're not immune to security issues as well. There have been a number of issues. Ether Delta was one of the first that had a smart contract, almost a hack through a smart contract essentially. Bancor's smart contract was breached as well. So there's been a number of different issues with smart contracts. But overall, I think it's definitely worth examining the trade-offs. But still, I think that when you're looking at like what happened with Quadriga, nobody's going to necessarily die with your crypto if you're holding your own crypto.
Right. All right, so let's come back to private keys. Itai, can you talk a little bit about, what services maybe are available? How can customers make sure that they hold on to private keys without, forgetting what their passwords might be?
Right, so in order to understand, first of all, let's understand what happened in Quadriga, right? And what led, assuming that he actually held that private key, and that there's no conspiracy here, why did he make that decision to hold that private key? And so we need to go back and understand what are private keys. So how do I hold an asset on a blockchain, and how do I move it out to some third party or someone that I trade with? And that is done through public key cryptography that is based on private keys, which are very long numbers that can also be represented through a set of about 20 English dictionary words. And the owner of those private keys is the owner of the asset, and they can make any decision to move that to some third party. So holding that private key in a blockchain kind of setting, in which there is no authority to which you can go to if the transaction is transmitted, creates an irreversible single point of failure. And he recognized that this is an irreversible single point of failure. So he decided to put it in the place that was the most secure that he knew, his own mind. What he did not understand was that by making that decision, he himself became that single point of failure. So now you ask, okay, and you're going to always have this trade-off between whether I can secure my private key or I can trust someone who can do that better than me. And maybe for consumers, they would trust exchanges or custodians better than they can trust themselves. So you're always going to see pools of crypto held by organizations. And the issue with private keys when they are held by organizations is that you have to create a custody structure for the organization. If it was not him that was the owner of those $190 million, it was QuadrigaCX, right? So he should have created a custody structure that governs the ability to spend funds out of Quadriga. And that custody structure, that's common practice today in the financial world, right? Any corporate account has more than one signer, right? And has limits through which you govern who can spend funds outside. But you don't have that in crypto. And the question is why? And the reason is that you still have that private key. And that private key, which is the single point of failure. So what do you do with that, right? Do you give it, so let's say you want to have several employees to approve transactions or whatever. What do you do with that private key? Do you hand it to all the employees, or do you hand it to one of them or some of them, right? Where do they store it? Do they store it online? Do they store it offline? and how often do they need to access it? And every organization, when you look at those questions, every organization will have different answers based on the properties of how they need to use those assets.
Right. So let me stick with you for a minute. It seems to me that one of these issues that kind of keeps coming up is that there's trade-offs everywhere, right? If you hold your own private keys, then you become a single point of failure. If you use a centralized exchange, that centralized exchange might be, the point of failure. I guess, how would you maybe describe, the differences between the security versus the availability of your private keys? What seems to be the most explicit trade-offs to you, and like, how would you weigh them if you're making this decision?
Yeah. So when you look at the basic trade-off is between security and availability. Security being, if I'm the owner of the asset, how do I prevent an adversary from moving that asset to where they want and not to where I want, right? And availability being, once I made a decision to move the asset to someplace, how quickly can I do that and at what operational cost, right? And you see that trade-off all the time, right? You see hot wallets being hacked because they wanted to get high availability, right? And that high availability is in a machine that is connected to the internet, so you have cyber attackers trying to get to that machine. On the other side of the spectrum, you have cold wallets or brain wallets in this case. And by the way, he got 100% security. The result was 0 availability. Okay, so you have this this trade-off between them, and I think that to the how you can solve this and to the rescue is how do you solve any risk, right? You distribute the risk. Any financial security risk, eventually you want to be able to distribute it. And specifically here, I think that the world is going towards a way in which you take that private key, that secret material, and you distribute it among many parties.
Okay. So, Rob, for those customers who, absolutely positively must trade cryptocurrencies and, for whatever reason are absolutely positively completely loath to use a centralized exchange, what should they be looking into when you're looking at decentralized platforms? What factors should they consider about those platforms?
So I think there's a couple different factors that one would want to consider. There's varying levels of decentralization. I think really with everything, whether it is a platform itself or if it is a decentralized peer-to-peer trading venue, whatever it might be, there's certain elements of centralization and decentralization. I think that it's important to try to evaluate those prior to. But when you are looking at decentralized trading, some of the things that people probably want to consider is the wallet I used, or the wallet I keep my crypto on, is that supported by it? Does it support a ledger? Does it support a Trezor? Does it support MetaMask? In some cases, does it support the asset that you want? Because for a lot of these different decentralized trading platforms, many of them right now are Ethereum based. So you're limited to Ethereum or ERC20 based tokens. That's a pretty wide field, but at the same point in time, you're not able to necessarily directly trade Bitcoin, which is still by far the most liquid crypto asset, which has led to the creation of something like WBTC. But I would look at availability of the assets, the trustworthiness of the kind of developers, and just at a high level try to evaluate how centralized that service might be.
Okay, so let's broaden the conversation a little bit. Last week, Binance reported that it got hacked. Malicious actors were able to steal 7,000 Bitcoin from their hot wallet. At the end of April, crypto exchange Bitfinex, as it turns out, lost access not to its crypto. Its crypto holdings are fine, but it couldn't access its fiat reserves because the payment processor it was using had been seized by federal authorities in 3 different countries. These seem like major issues for centralized exchanges in particular, but it also seems to me that majority of customers and crypto users around the world are still kind of looking to centralized exchanges simply because ease of use and ease of accessibility. So Oren, can you say maybe how do you kind of react to that? How do people deal with suddenly learning that, okay, this exchange I've been using has lost $850 million, and they hit it for 4 months.
Sure. Yeah, I mean, maybe just to touch on the decentralized exchanges briefly.
Sure.
One of the ways that we look at it is that decentralized exchanges they're certainly an important part of the ecosystem. I think there was a panel earlier today where someone was saying, the market will decide if that's the solution that they want. Right now, centralized exchanges certainly cover the majority of the market in terms of volumes, number of users participating. We think that decentralized exchanges are more in the spirit of the entire blockchain distributed ledger, kind of the idea of it. But one of the concerns that we see, especially with institutional participants, is that you don't know who you're participating with, right? Who is the counterparty to your trade? So we see, I think that there's some really interesting solutions that people are talking about in terms of federated identity. Ways that maybe those decentralized exchanges could employ some kind of identity mechanism so that it is a known and trusted counterparty. But for us today, decentralized exchanges, for most of the customers that we talk to, they're not interested in it because of that risk. So going back to the centralized question, or the centralized exchange perspective, I mean, again, to come back to the regulatory part of this, a lot of this stuff with that exchange came out through a regulatory, through the application for the bit license, I think. So I think, again, it just goes, there are lots of exchanges out there now, all of the big names, or not all the big names, but a lot of the big names, that are actively going after these licenses, and they're doing that. It's not fun to do these applications. Going through an audit, if anyone has gone through like a SOC audit, it's a tremendous amount of painstaking work, and so they're doing that to protect their customers' funds. So I think it's a critical criteria for someone in this space to look for that exchange operating within a regulatory framework. Are they going after licenses? Do they have third-party audits? Do they have things like proof of reserve, proof of solvency? Do they have, are they working with insurance providers, things like that?
Right.
Critical.
So, I know you wanted to talk a little bit about, how enterprises and institutions can maybe also tap into holding their own private keys. Can you kind of expand, on your view on that?
Yeah. So, again, the challenge for an organization, as we mentioned, because of the private keys, there's some trade-off between availability and security. And to the rescue is decentralization. And the solution that Curve has got to market, but is based on some advances in the academia in the past years, is to eliminate the private key altogether and to apply a distributed security model to that private key. So it is possible, what was a few years ago people did not conceive as possible or as very computationally inefficient, it is possible today to create a public key where there is no private key behind that, in which the cryptographic material is distributed between many parties. And how do you now leverage that fact that you can do that? Many ways. One of them is to distribute the cryptographic material among the employees of an organization, for example, right? So now, it's not that one employee will hold the entire secrets to the organization. You're going to have several of them, and you're going to be able to apply some policy saying which employees can approve a transaction, and through multi-party computations, create a transaction and then send it to a blockchain. And you can do that not only within an organization, but also between organizations, so that you can have a consensus mechanism for that private key without having that private key in the first place. And to give some intuition, so multi-party computation is a field in cryptography for like 30 years ago that enables several parties to calculate something together. So in this case, we want to calculate a digital signature. But for the sake of the crowd here, let's say we want to calculate the average salary of all the four of us, right? Without handing each of our salaries to some fifth party, right? And without revealing our salaries to one another. So a very simple protocol would be, I would take my salary, right? I will have a random number, which I think about it, I don't tell it to anyone. I'm going to add those two numbers. I'm going to send it to you. Now, you have the sum of a random number, which you don't know, and my salary. So he didn't learn anything about my salary. Now, he will add his own salary to that number and send it to you. And you'll take your salary and send it to you, and you're going to send me back. So now I have the sum of all the salaries plus a random number that only I know. I'm going to subtract that random number, and voila, we have the sum, and we can calculate the average. Now, take that concept in which there's a protocol running between several parties. No party reveals anything to one another, and apply this to digital signature itself, right? What you get is a way to have a distributed private key that is never existent at any point in time. The sum was never existent. And the advantage of this is, of course, security. This was possible 20 years ago, but it would take years of calculation, and it is possible to do it today very efficiently. And we're going to see this entering both the exchanges and also prime brokers and custodians across the industry.
Okay, so I guess how would you tie that back then? So that's something enterprises can do. Is there a way to tie that back to maybe an individual level, or to even the exchange level for customers, for your average retail customers to take advantage of?
Yeah, so you can have the same model in which the individual has one share of the secret, and the service provider, it can be an exchange, it could be a wallet application, has another share of the application, right? So if someone breaches that wallet provider or that exchange, they don't have anything. They only have a secret that is immaterial, because they will need to get to each and every one of the consumers in order to be able to substantiate a transaction and steal the funds. So these kind of schemes we're already seeing, and because of the efficiency, this is now possible both for the consumer benefit, but also for the organizational benefit.
Awesome. So real quick side note, we are going to take audience questions. If you want to start making your way to the microphones on either side, you can do that now. More broadly, though, we've been talking a little bit about how customers can protect themselves, how exchanges can prove that they're not about to run away with your money, how DEX doesn't work. Broadly speaking, what would you want people who are, for whatever reason, deciding, okay, I have my entire life savings, I want to put it into Bitcoin. What would you want these people to know, not just necessarily about exchanges or wallets specifically, but just in general about their first entry into the crypto space, and this is how they decide to enter it?
Well, I think first of all, you need to understand that it is a risky business, not just about the price of the Bitcoin going up or down, but also about the fact that the assets can be stolen, and they should ask themselves who is the one that they confide in, and whether they confide in that organization better than they confide in themselves, and what assurances or maybe insurance they can get from that organization.
I would say that one of the big things, whether it's Bitcoin or any cryptocurrencies, is there's a certain level of desperation that people have, and I think QuadrigaCX was initially really the only place to get Bitcoin in 2013. And a lot of the other hacks, too, have always occurred for the exchanges that people kind of go down the ladder of I'm most desperate, whether it was Mt. Gox was the only place to get Bitcoin at the time. I forget the name of the Italian hack. It was CoinGrail. That was the only place to get Nano or Raiblocks at the time. There's a lot of times where it's like, this is the only place to go and get Bitcoin. Sometimes there's a reason for that, and you want to look into why is this the only exchange that is serving customers in my jurisdiction, and should it actually be serving customers in my jurisdiction? And you just have to do a little bit more of a deep dive into that.
Yeah, I think it goes without saying that putting your entire portfolio is probably doesn't follow the best practices of portfolio management, but yeah, you can understand that people, no matter what amount of money they put in, they expect some level of certainty that those funds will still be there. And I think it goes back to this idea of working with reputable exchanges, ones that have been in business for a long time, that operate in different geographies, that are very public about the processes that they follow internally, the technologies that they use to protect customer assets. The more forthright an exchange is about those things, I think the more secure a customer can feel about that.
All right. If you want to, yeah, that.
So
Yeah.
there's a long lineup here for questions. Yeah, so this problem of key management is not new. The X509 PKI space has been at it since the mid-90s. How many of you guys know what, when I say certificate practices statement, you guys know what that means? Has anybody there on stage actually read a CPS statement for a key holder? So I suggest that if you're an exchange, that you should Google CPS statement. So what that is, because this is an answer to your question earlier, if I was a customer, I look at an exchange, how do I evaluate? Is this good, is this bad, is it fake? Look at reputation, whatever that, however you define that. So one way you could do that is for an exchange to publish a contract. It says, if I lose your key, I am liable for, put a dollar value, $100 million, don't put it there, right? So that's what the PKI industry did for keys. We're talking about corporate keys for huge corporations, right? So if you lose the private key, then the whole organization is toast, right? So, and we're talking about hardware, galore. We're talking about having, audit companies coming in every year with reports. It's a real operation, right? This key management is a serious business. There's publications from NIST galore, the 800 SP series. Please go home and read that. So, that's one way, is for an exchange to post a PDF, right? And so I was chief scientist for VeriSign for a long time, first founding. Our CPS statement was 105 pages with warranties, liabilities, procedures, everything listed. That's how I would read an exchange's performance. If an exchange does not have a CPS statement, people run for the hills.
All right, thanks. And just, I guess, tying that in with what you were saying about, wanting to trust or look at the, reputation of the exchange. My understanding of Quadriga was that it was, if not the longest running, certainly a long running exchange, and at the time of its collapse was, I believe, the largest exchange. So I think, yeah, it's just in Canada, sorry, yeah, in Canada, not in the US or literally anywhere else. It was the largest exchange in Canada at the time it collapsed, and yeah, it's just, I guess it was at the end trading on its own reputation, but at that point I believe most of its team had left. So I think we're out of time, but this was a great discussion. Thank you guys for joining me, and hope the rest of y'all continue enjoying Consensus for the next day and a half, and thanks for coming out.